4 factors shaping the global economy. Number 1. Global growth remains uneven.
Global growth in 2015 is going to be more or less the same as in 2014, about 3.5%. That's not bad, that's not great. Now, if you look at the numbers behind this global number, it's clear that advanced economies are going to do better. So our forecast for this year is 2.4% as opposed to 1.8% last year, a fairly substantial increase. And then for emerging market economies, it goes the other way, which is 4.6% last year, but 4.3% this year. So advanced economies are doing better, emerging markets and developing economies are doing a bit worse, not terrible, but a bit worse. And the sum is more or less no change at the global level.
Number 2. Weak banks and high debt levels weigh on growth.
It could be seen as a puzzle because the interest rates are very low. Fiscal consolidation has nearly come to a halt, and still growth is not very high. So I think the main insight here is financial crises have long scars or leave long scars. And basically various groups end up with higher debt. So we focused a lot on public debt, which is high, but you have household debt, you have corporate debt, you have bank debt or bank leverage. And it's not that all countries are affected by all these factors, but in each country or in most countries, there is one of these things which is not right. There's a level of debt which is too high. And when your level of debt is too high, if you're a household, you have too much debt, you spend less. If you're a corporation, you have too much debt, you invest less. And that's slowing down the recovery. It will take quite a while for this to go away.
Number 3. Oil prices have declined by about 45%.
Lower price of oil is good news for the world economy on net. Now you have to clearly to distinguish between the oil importers and the oil exporters. But among the oil importers, you have the US, you have Europe, you have China, you have India, you have all the big countries. And for those countries, the fact that you're paying less for oil means that you have an increase in real income. And this means that consumers have more to spend on other things, that firms can invest and so on. So you have an effect on spending. And the evidence is still early, but it looks like it's happening. So for these countries, for the oil importers, it's very good. Now, on the other side, you have the oil exporters, and clearly for them it's not so good. Most of them have built fairly large buffers in the past, so they can adjust to it. Some of them, a few of them are in trouble. But again, on net for the world as a whole, good thing.
Number 4. The US dollar is strengthening.
So exchange rate movements have been quite large, right? I mean, you've had the euro depreciate vis-à-vis the dollar by about 25% since the beginning of 2014, the yen depreciate by more than 10%. So these are big movements. Is it good, is it bad? Again, on net, I think it's good. Because the countries which are benefiting from it, or are going to benefit from that, are Japan and the Eurozone. They were not doing very well. That's going to help them. We were worried about the risk of recession in Europe. We're still a bit worried, but less as a result. Now, look at the other side. For the US, a strong dollar is good, but it slows down spending, it decreases external demand, and that might be an issue. But the US has tools to respond to it. If the economy were to slow down, they can delay the exit from the zero lower bound, increase interest rates later. They may be able to use fiscal. So we think on net, it's a very good thing.